operational blockchain, which helps businesses actually build specific codes on top. And so in 5-6 years, this technology is comparable to AI, which has been there for decades. And the reason is very simple. This technology has uses almost every industry that I can think of. There are like multiple use cases from healthcare, automotive, shipping, logistics, drug delivery. I mean, you name it, and there's always a use case, and people are working on it. That is the reason why this technology at this level. Now, to give a broader context, I want to first tell a story and then obviously see how that story applies to the financial sector. So, year 2003, the world, the global music record industry, if you look at it globally, had a revenue of $20 billion, right? And fast forward 15 years, the revenue shrunk a little bit. It's now $19 billion. However, very interesting thing has happened. The composition of this revenue, almost 50% is coming from a newer delivery model. And what is this delivery model? It is basically streaming. So streaming 15 years ago wasn't even a thing. And in 2018, it has almost eaten away 50% of the revenue. Why that has happened? Of course, first let's look at who are the players. Of course, Apple, YouTube, Spotify, Amazon Music. So in large, these are the guys who are sort of controlling it. Of course, one way of looking at it is, internet came about. This was the era when a lot of internet companies were mushrooming. And therefore, very conveniently, we can say this new business model emerged and it took away a share from the existing brick and mortar setup. But actually that overlooks and simplifies the real problem. 2003, if you had to actually get your music, you had to go to a physical store and buy your music, or you had to order it and get it shipped to your place, right? So there was this access issue. You had to go there physically or order it and wait for a copy to arrive. 2018 or now, all you have to do is obviously have this music on demand through your streaming, you get it, right? So that access problem actually has gone away, and that is why streaming is gaining more popularity, because now it's music on demand whenever you want it. So I think there was a major access issue back then, which was solved by these new age internet companies, which spotted a problem and tried to fix the solution. Now, if you look at the finance industry, it has very similar issues. So if you have to today get access to a financial industry product, a loan, mortgage, all sorts of bank accounts, but basically get an appointment, show up at the bank branch and, submit all your documents. They run through, their own numbers, and then basically you're allowed to go back, and then you hear from them after a week with all that they were processing is all fine. So that is one aspect, which means you have to physically go. There is an access issue. If you don't have a bank close to you, of course, there is a lot of digital and other things which are taking shape, but still not there. You really have to be there physically. Two, if you are unemployed or if you are a student, right? And again, I'm just picking those two sort of categories. There are a lot of other categories. And then you try taking, accessing some of the financial industry product. Like, it's very difficult. Why it's difficult? Because you don't have a history. You don't fit into the exact model of how they would like to see their ideal client. So if you don't fit in, therefore you'll not have access, right? So I think those are the two fundamental problems which are plaguing the financial industry today. Now, before we even get there, I think one question which I was thinking when I was preparing this presentation is, why does the financial industry actually even exist, right? What is it that the industry offers, especially when all these people are coming up with newer models? First and foremost, imagine, you're sitting in Nebraska and I'm here in Delhi, and, you want to do a transaction with me, right? So there's a straight away counterparty risk, right? How do you trust me? How do I trust you, right? That the money you are sending or the goods that I am going to be sending are going to be received. What if you make the payment and I don't deliver the goods, or I deliver the goods and you never make the payment, right? So that risk is always there. And what banks do in this case is they come in and they say, okay, I'm going to take the counterparty risk because I am a reputed trusted bank. So in bank, you trust. So if you put in the money there, your money is going to be delivered on the other end. If nothing happens, the money is going to be reversed to you, right? But your money is not going to be lost. So how do banks do that? right? Obviously, a very straightforward, efficient way is, this particular bank in Nebraska, maybe it's a credit union bank there, also has a branch, I'm in Delhi, so maybe it's a branch in Delhi. Then obviously it's a very internal transfer, very straightforward. But imagine, this is a credit union and there are, thousands of remittances and cash flow outwards every month, maybe even every day, right? So it is not really feasible for this small bank to have branches all over the world. So what does the bank do? The bank then relies on something called as a trusted financial institutions network, right? And what is this network? This network is nothing. Banks like this credit union in Nebraska. There are banks here in India. There are banks everywhere. So India, obviously, one of the very popular government-run banks is the State Bank of India. So what this credit union would do is basically rely on the network of this local, powerful bank, and establish a communication medium in between, and then they're able to transfer the funds. Now, for this to happen, obviously, all these different institutions have to be part of a specific network. And this network, by and large, is like a consortia, such as the SWIFT Society. All those who do regular outward transfers, they would know. They use like the SWIFT code. The SWIFT code is coming from the SWIFT Society's nomenclature, right? So if I have to simplify this whole process, I think banking largely is more or less like a messaging service, right? At one end, you get a specific message that this is a legit actor and this is a proper transaction, let it go through. And how do you let it go through? Through various intermediaries and trusted institutions, which are part of the same group. Now, with all this network in place, there is a risk, obviously you are centralizing information. You're centralizing information on all these different banks. You're centralizing information on the clients and customers of these institutions. And we're going to talk about how that is risky, but at a very high level, that can lead to hacks, data breaches, privacy issues, and a whole host of other issues. Now, not only that, once you're using a trusted financial institution, then you're taking their services, and services come at a cost. And who bears the cost? Bank doesn't bear the cost, it's the cost that we bear. And what is this cost? It's primarily the wire transfer fund, money that you put in every time you're sending money outwards or even inwards. Sometimes, it almost $40, $45, $50, right? And if this is for remittances, a small ticket value, $200, $250, then that $40, $50 is a lot of value. Yeah, but it's 50,000, 100,000 is a different story. But there's a cost involved, right? And the cost comes in because there are a whole host of intermediaries who have to be paid. Now let's look at very quickly how blockchain helps solve some of these problems. But before that, let's also look at what is blockchain. So at a very high level, I put blockchain as a sort of a ledger or a database, which we all know, but with a difference. And the difference is this database is spread across millions of devices who are part of the network. So let me explain this. A traditional database, such as the database on Amazon, Facebook, Google, it's all controlled by them. They have the copy of the ledger. Nobody else has a copy. In blockchain, anybody who's part of that network will have the same version of the data, right? So they will all have the same database copy. Anybody globally can go and view that information, but only a selected few have the ability to go and modify. So think of it as a giant interactive Google spreadsheet where information is totally transparent, but only few people will have access rights who can then go and modify. I mean, I'm saying modify. In essence, you can't modify anything on blockchain. You can only add information because the blockchain is immutable. So that's one part. How does transaction get stored on this ledger? So transaction gets stored on this ledger in batches. So there's always a fixed number of transactions. Once they are completed, then a batch gets executed and it gets stored on the ledger. What is this batch called? This batch is actually called as a block, right? So information is arranged in block of transaction, and that is how it gets stored. Another interesting thing happens is this block is always pointing to the previous block and is connected cryptographically. So think of this whole structure as the ones you might have read about, in particular the linked list, right? So one data point is referring to another data point and it's connected. So here it's a block which is basically linked through cryptography. So let's take a look at the actual storage structure. So think of this as any centralized service provider. We were talking about Amazon, eBay, Facebook. So information is getting transferred from all these different devices, desktop, laptops, mobile devices, coming to this central data point. It's basically the data center, those cold dark rooms. And this is the copy of the ledger here, right? So the copy of the ledger is most updated version controlled by this central authority. And the structure looks something like this. Here you have this information stored critically, and all these different nodes are contributing information. The ability of individuals to contribute information, I think here is fairly limited. So you and I, if this is Amazon, we can probably go and change our shipping address, our billing address, we can change our mobile number, some of the other things. But critical aspects such as my KYC, if I have to change my passport, all that has to go through the admin. So the ability of end users to sort of change or make changes is limited. Admin has a lot of rights. Contrast that to blockchain storage architecture. Here, obviously, which is peer-to-peer. Blockchain is all peer-to-peer. Here, everybody will have the same copy of the ledger. So these are all different devices, and they have the same copy of the ledger, right? Here, as I was saying, only Amazon or Facebook will have the copy of the ledger. Here, everybody has the same copy of the ledger. And a transaction happens. Imagine a transaction happens here. As soon as the transaction happens, it gets propagated throughout the network. It gets propagated throughout the network, and the entire network updates the copy of their ledger, and everybody is again on the same page. So the version of truth is still same, but it is distributed and everybody has the same version of truth. Whereas here, the version of truth is controlled by the central authority. And this is how the network looks like. I'm just showing 6 devices, but these are millions of devices spread globally, and these are all interconnected. So here, obviously this is the central point. Here, there is no central point. So imagine for a second, a hacker is able to get into the system, right? And of course, this has the highest levels of digital security and highest levels of physical security. Yet, I mean, all the hacks that you've heard of, whether it's Marriott or social security number, whatever that is, this is how it happens. So you have a single point of failure, and that is where the hacker comes in and attacks. And as soon as he's able to attack, he's basically able to bring the entire network down, right? Now, compare that to a blockchain network, right? Here, as I was saying, everybody has the same version of the truth. So if somebody has to actually alter the state of blockchain, they have to launch what is called as a 51% attack. And there are a number of other attacks, but imagine this is a 51% attack. So there are 10 million devices on which the network is running. Everybody has the same version of the ledger. So if you have to bring the system down, you have to basically hack 5 million devices at least, and you have to do it simultaneously, which is virtually impossible, right? Technologically, it is not possible. Technology is not there, and obviously economically not feasible. And that is why blockchains today are hack-proof, right? Doesn't mean they're going to be in future. Obviously, hackers are getting better. Then there is quantum computing coming in. So a lot of innovations and things are moving both directions. But today, where we stand, blockchain ecosystems, by and large, are hack-proof. So provide very, very high level of security because of this reason. Now, let's look at the actual mechanics, right? And after this, we'll basically talk about the use cases. So imagine there is a transaction that happens between Alice and Bob. So Alice maybe is transferring $100 to Bob. And that transaction is part of this pool here. This pool is called as unconfirmed transaction pool. So as soon as a transaction, or a set of transactions are there, as I was saying, each blockchain will have a specific number of transactions fitting into one block, and then it is approved and processed by the network. So imagine in this block, in this blockchain, each block has 5 transactions. So now what happens out of these 15 transactions that you see here, the network rushes almost competing against each other, trying to pick up those 5 transactions, which should comprise the next block. And obviously, there's a lot of brute force computation involved at the back end. We don't want to get into that technical discussion now, but suffice it to say, it's fairly complex to the extent that normal computers, GPUs, etc., are not fit for that computation anymore. There are application-specific devices worth at least $15,000, $16,000, which people have to invest in to be able to run those computations. So critical part about these computations are millions of permutations, combinations you're running in a very short span of time, more or less 10 minutes, right? And you're competing against the network. Why would people do that? Why would people compete against each other, invest so much in the devices? Very simple reason: they get rewarded. And the reward in this case is, again, everything is computed through the software of Bitcoin for all these years. So people get rewards. Today, that reward stands at 6.25 Bitcoins, translating roughly to about $70,000 to $75,000. So for 10 minutes of computation effort, you could earn up to $70,000. Again, I mean, it is not that simple anymore, but that is how it is. So that is one draw for a lot of people to come and verify transactions. Secondly, since you're part of the network, that is how you're able to verify and look into the transactions, which means that you have a vested interest. You already have certain Bitcoins or any other cryptocurrency which you're part of the network of, right? So you want to make sure that the network is always in good shape. Therefore, you are providing security, right? Which means you're always checking whether the actors are legit, whether the transaction is legit before you approve it, because you have a vested interest. So it's basically crowdsourcing the security of the network. And that is why, millions of these devices, whoever are the part, they have to basically contribute towards that. So those two things, and let me just show it up here as well. This is how the block actually looks like. So you have something like a block header, data and information, a lot of things. We were talking about points to the previous block. So you see it's the first item in the block header, and all the way rest of the information or metadata, and then the transactions. You run a hashing algorithm, and if you are able to hit a specific target, then you are basically rewarded. Otherwise, you continue with these computations, right? And the outcome of this whole exercise is a new block. And this whole concept of coming up with new block is called as mining. Why it is called as mining? Because obviously people get really rewarded handsomely, as we were talking about $70,000 or so. And they're borrowing this idea from mining rare metals and minerals, right? Gold, diamond, etc. It's the same sort of philosophy here. So the network approves the transaction. So as soon as you submit a block, network is going to verify the calculation and say, yes, this is all fine. They're going to approve it. And then the transaction goes and gets stored on the blockchain. So imagine this new block after these 5 transactions is block 358. What happens? This goes and gets appended to block 357 in this case. And as I was saying, there's inception to date record. This is how they are pointing to the previous block. So block 358 points to block 357, block 357 points to block 356, and so on, right to the Genesis block, block 0, right? Now, this was a very interesting dynamic here. So imagine a malicious actor trying to alter the state of blockchain. So you know what, transaction 3 maybe should not go in this block. Actually, it should be transaction 9. Fine, you put in the transaction 9 here. This is a new block structure. You sort of try to fit in here, but there's a problem. You cannot just change block 358. You have to go and change block 357 because inception to date records are there. Therefore, you go to block 357. When you go and change block 357, you have to go and change 356. And likewise, till block 0, right? So basically, what you have to do is you have to change the data on all the blocks ever since the blockchain has been in existence. That's number one. Number two, anything that gets stored on the blockchain has to be approved by the network, which means you not only have to make all these changes across the board, you also have to get the network to approve it. And those two things together obviously are not possible because the network is never going to approve such a change, and you also cannot make those changes without getting noticed. That is why the blockchain is hack-proof because of all these reasons. You cannot make changes. You can only add information, and you're immutable, and the network protects it. So with that, premise or the background, let's look at some of the relevant aspects of blockchain, which actually helps the financial sector to actually move to the next level. I'm talking mostly from the blockchain perspective. Obviously, we are referring to the traditional financial services as well. So decentralization, the concept that we talked about, there is no single person controlling any of this information. There's everybody who has equal access, who has equal right. Then this is distributed. The next step is obviously immutable. Immutable, we talked about, you can only add further information through newer blocks, maybe referring to the previous block, but you cannot go and change things. And finally, smart contracts. So smart contracts is a very interesting sort of thing which has come up with blockchains. Of course, it's been there for several decades again, but it really found good use in blockchain. Smart contract is nothing but mimicking real world contracts in the form of programs, self-executable programs. So let me quickly explain this to you. Imagine seafoods have to be shipped from a specific location to a restaurant, right? And it has to be stored always at less than -40 degrees. So the way it works is you take the goods, your produce there, and it gets verified, inspected, and they say, yeah, this is fine. And then there's a lot of paperwork. And then eventually there is a credit period after which payments are released. So this is the cycle. So the contract is goods are received in a acceptable condition and you get paid. Right now, what happens in the case of smart contract is this information, because it's all sensors, temperature loggers, everything is there. So it is completely possible to track the entire journey of the shipment, because all this information then gets stored on the blockchain. So it is immutable. Nobody can tamper with that information. Therefore, as soon as it reaches the restaurant or wherever it is supposed to get offloaded, that information is straight away read from the blockchain, and you know what, it is always on the lower side of the tolerance. Therefore, we can accept this. But instead of a person accepting it, it's the system which accepts it. So the smart contract takes in this input and then approves the transaction by saying, yes, this is a good produce in the right shape which we want, and automatically money gets transferred to the bank account. So this whole thing through the smart contracts runs in a very efficient way. So these four features actually make it a very powerful offering for the financial services. So there's no single point of failure, and there is unparalleled security along with all these four things, which make it very, very lucrative for the financial industry to actually try it out. Now let's look at a quick use case here. Global payments industry, one of the biggest industry, obviously worth $110 trillion at this point. A small subsection, close to 20% comprises of cross-border payments. This is $22 trillion. Revenue from this is 50%, right? Which means highly profitable. Yet they lose roughly 8% annually in terms of transaction fees. So we're talking about $1.6, $1.7 trillion being put in transaction fees, right? If you can shave off, let's say, half of that, you can save a lot of money. A subset of this is the world remittance market. So remittance is, people sending money back home to friends and family for, sustenance, education, gifts, whatever that is, right? So this market is worth $689 million, out of which 52 was the spend in transaction fees. Again, a very high, substantial amount. What makes it more interesting is when you see a further breakdown. So cash to cash transfers is 96%, right? And out of this, family maintenance 60%. So you see, it's like almost for sustenance, a small ticket for sustenance, send it back home, right? So it's a lot of money for people. And India is a very interesting example here, $69 billion, more or less. India is the highest inward remittance receiver, right? That's because, maybe of the diaspora and also this culture of sending money back home. And this is at an average cost of 3.29%, which is still high, but against the industry standard, I would say it's a very, very competitive price. And why this is competitive? Because, as I said, it's a very busy corridor, right? And therefore, there's a lot of competition. There are a lot of solutions out there. Now, if you contrast that with sub-Saharan Africa, this number is 9%, extremely high, right? And if the average ticket size we are looking at is $200 or $250, and if somebody loses 9%, right? Imagine a family of 4 or 5, right? Dependent on this $250 a month. And you just take away 10%, that's a lot of money, right? The point that I'm trying to make here is that the system is inefficient because there are a lot of intermediaries involved. And of course, they're there for a reason, they add value. But probably some of the newer business models which are emerging are actually taking all these things head on. Quick comparison, if you are to send $50, right? Again, the number could be anything here. So bank transfer going to charge you $5.20. Keep going down, you reach this cryptocurrency, Litecoin, and there are so many others. This is only 27 cents, right? So from $5.20 to 27 cents, that's the quantum jump, right? Which you can achieve when you're using some sort of blockchain-enabled solution. Now let's look at the mechanics to sort of get clarity as to why this thing happens. So again, going back to our Nebraska example and Delhi, right? So this person, in Nebraska reaches their local union bank, credit union bank, says, I need to transfer, let's say $200, $300 to somebody in Delhi, right? Okay, you fill the forms, you give in all the details, and then this information is relayed to the central counterparty. In this case, obviously, is the Fed. The Fed then locates what is called as a correspondent bank. And what is a correspondent bank? A correspondent bank is a bank which has some sort of a banking relationship with the country in which we are trying to sort of make the funds transfer. So imagine there is a correspondent bank in the network which deals with Indian banking system, and so there's a correspondent bank on the other side in India. So as soon as this relationship is established, message goes through from the Fed to this sending correspondent bank all the way to the receiving bank saying, hey, this is a transaction by this XYZ in person to a person on this bank, this particular branch, right? So money information flows here to this bank, then it goes to the central counterparty. In this case, since it's India, so it's the Reserve Bank of India, and through the Reserve Bank of India to the main bank. In this case, it could be we were talking about a State Bank of India. So imagine a State Bank of India, and then the specific branch where the receiver has an account, right? That is how the money routes. So it takes roughly 3-4 days, comes at whatever cost we just spoke about. To that extent, money obviously has received safely, but it has come at a cost and it takes time. If you contrast that with blockchain, it's basically straight transfer. Sender can directly send money to the receiver. Receiver, can get that confirmation in 10 minutes. I mean, depending on what sort of blockchain underlying infrastructure using, it could be seconds, but at the most it is an hour, right? And you are able to make these transfers. And so you're cutting all these intermediaries, which you see in the dotted box. You're saving time, you're saving money because you are dealing peer-to-peer. And why is that even possible, right? The reason why it is possible is because the new age blockchain-based infrastructure doesn't require, trusted parties to provide trust. The technology itself, because it is immutable, because nobody can hack it, right? All the good features we've been talking about, that enables that trust in the system automatically. So you don't need to get in any more trust, right? And it comes at a fraction of a cost. So let's look at the innovations in the financial sector, right? And before we do that, let's first look at the current financial system. So the current financial system obviously provides unparalleled, access to financial data to all these banking and for financials. So kind of data that we generate are, bank accounts, credit history, I don't know whatnot. There's tons of data, but that becomes a proprietary data for the financial institutions to basically take control, right? So unparalleled access to data. Secondly, sovereign insurance on all sorts of deposits, right? Anything is obviously sovereign, insured. Second, there's a special status as regulated institutions that can supply credit, right? Again, a very, very powerful, advantage. And then finally, because they have been there for years, there's also this huge, large distribution network in different branches spread globally, right? So you see, this whole system is to a larger extent very monopolistic, right? You have access to kind of data which nobody has. If a new banking and financial institution has to come in, there is a lot of entry barrier, right? There's a huge entry barrier. There's a huge regulatory compliance need. And moreover, there's a huge capital requirement, right? So a new branch, a new bank or an institution cannot come in easily. And that is one of the reasons why the incentive to innovate in this sector hasn't been there, right? Yeah, there are tweaks here and there. Obviously, the fintechs have started to chip in and shave a little bit, and therefore, more and more banks are talking about digital and trying to change. But if you look at it, by and large, not a lot has changed in the last 50 years, right? And that is where, when you look at blockchain, how it is looking to change and why some of the financial institutions are taking interest, it becomes amply clear this is the reason. Now let's look at fintech. So fintechs obviously have been there for the last decade and a half. And I would say they've been successful in certain pockets. I would say primarily in the retail space. And things that have been doing, obviously, peer-to-peer lending is a big one. Lending clubs and their alikes being very, very popular. Then crowdfunding is another area. Cross-border, again, they're looking, because there's a pain point. We talked about sub-Saharan Africa and the other things. So it's another area we're really looking at it. And underserved, categories. What are these underserved categories? Imagine, small and medium businesses who have not enough sort of credit history to be able to access financial industry products. So those are the ones who get addressed by the fintechs. So they have been successful in some of these areas, right? Yet, fintech hasn't disrupted the financial business, right? And why is that? Because a new fintech, first of all, needs to have access to clients, right? Without clients, how would your business grow? How would you really be able to do anything? And if you're new, especially in this business, it's very hard to get clients. Of course, that thing is also changing. But the easy way then for a fintech is to partner with the existing banking financial institution, right? And that is what happens quite a lot. To get access, there's partnership, right? The other benefit of that partnership, it reduces the regulatory and compliance burdens, right? Because now the bank is taking care of that, and obviously they're going to be guiding you through their own internal processes. But you don't have to bear the heavy expense and other things associated with meeting all the compliance requirements, right? So what happens, in essence, you are ending up building the existing systems, right? The existing system wasn't adequate. There were inefficiencies, there were access issues, which we spoke about, similar to the music industry. And what you're doing with all this technology and innovation is still going and trying to fix the existing business in a way that, you get absorbed by a big conglomerate, right? And there's definitely not an approach which is a first principles approach. The ones we saw, for instance, in the music industry that I spoke about, or how Amazon sort of took away the, the retail commerce kind of business, or how ride sharing, right, is changing the transportation mobility business. So that kind of fundamental first principle shift is not there in the fintech space. Now let's look at blockchain. What is blockchain really doing? So what blockchain is really doing is it is actually creating a fresh underlying infrastructure, right? Which means it is not dependent on the traditional financial infrastructure, because the infrastructure is completely different. It is architected differently. So the problem with financial services, the fintech businesses, is that they have to rely on the existing and then make changes. Blockchain is actually creating its own infrastructure layer, right? So once you're creating your own infrastructure layer, which means you have to look at the problem from the first principles perspective. You have to really look at it very, very differently, right? And that is what is happening in case of blockchains. There's a fresh infrastructure getting created. Therefore, there's no way the existing infrastructure can be used, and therefore there's a direct competition. And secondly, because of all the good features that we've been talking about, right? Security, mutability, distributed, decentralized, smart contract, all of that, that straight away helps lowering the counterparty risk, because now you don't have to trust the other person. The system is there, and system is taking care of all that trust, right? So with that, what is happening now, there's a huge revolution called as decentralized finance. What is decentralized finance? So decentralized finance is primarily a financial sort of ecosystem built on distributed network, distributed infrastructure, right? Which is basically the blockchain infrastructure, offering traditional financial products. So traditional financial products in this case, bank accounts, loans, mortgages, insurance products, everything is being offered on a blockchain ecosystem. So applications built on top of a distributed network, which are in the financial space, are DeFi. And these are distributed applications. So distributed application, as you know, is built on a distributed network. So all this DeFi, decentralized, is all distributed as well. What this does is, you have universal access to financial products, right? Unlike if you are part of the traditional finance, you need to be a certain type to be able to access those products, right? Whereas if you are in a decentralized ecosystem, anybody has access. It's equal access, right? So equalizing the play field. And what is required? All you need is an internet-enabled smartphone on which you can have this DApp, distributed app, and you basically start playing in the decentralized finance. Again, no central authority, nobody is controlling it. It's all peer-to-peer managed network globally. Again, I'm simplifying things. That's exactly not where blockchain is at this point. It is evolving. So there is always a level of centralization. So there's, for instance, 75% decentralized, 25% is centralized. And why it is decentralized? For instance, if there are certain issues, certain security glitches, then at least the project team should have the ability to switch things off to make sure there is no financial damage. And once things are set in, then you can again reverse it. So the technology is evolving to that point, but it is already there. Like 75%, a lot of things like I don't store your private key. I don't know what's your personal information. So a lot of things I don't know, right? That is how it is being architected. And then it is global from day one. Imagine a financial institution wherever in the world they have to start operations. They have to go through so many local regulations, permissions, licenses. Forget about global. Like global is 10 years down the line. Whereas with DeFi, it's basically global from day one because it is a decentralized global network, right? And finally, it is permissionless to create applications and permissionless to participate in those applications. So, permissionless to create means, you can have a financial product, which is basically like insurance on derivatives, right? So you're taking a couple of these things, putting them all together, and you're building your own application. And this is happening quite a lot. So you have this underlying infrastructure blockchain layer. On top of this, you have all these Lego building blocks, and people are playing with it and coming up with newer versions, newer models. That's happening very often here. So what's happened is, you look at the industry's growth per se. So January of this year, the DeFi market measured in terms of total value, which is logged in the assets, was 650 million, right? And as per this morning, it is 9.2 billion, right? So in a span of 8-9 months, I don't even know what's the multiplier here, right? But you can see it's huge multiplier, and it is growing immensely, right? Month on month, day on day, it's really growing very, very rapidly. And things like, automated loans. So, negotiating between two parties, two strangers in two different countries, offering an automated loan without any third party involved, right? This is happening, right? This is not a futuristic tale I'm telling. There are applications which are letting people do this as we speak. So this is already happening, and that is a powerful, narrative for decentralized finance. So number of use cases are there. Let's talk about a few of them here. So this is lending. Lending space is where actually you have a digital asset which gets locked into a smart contract for a specific period, and there's an interest generated on top of that. And you are able to take loan against that asset which you have logged. And once you return the funds you've taken, you can take back your asset. And asset mostly these days, for instance, people try to put their Bitcoin in there because the Bitcoin value continues to rise. So Bitcoin is less of a utility now. It's more of like a precious asset which people are trying to hold on to. and therefore people don't want to sell their Bitcoin. So what that means is they would just put that into a smart contract, lock it for 90 days or whatever is the period, and based on the value, take that money and actually use it and then return it. So lending is a very big component. So out of the $9 billion, you can see 3.47 is coming from lending. Next one is decentralized exchanges. This is contributing to $3.65 billion. What is a decentralized exchange? It is like a traditional normal exchange, London Stock Exchange, New York Stock Exchange, wherever are these exchanges where you're, trading. So this is a trading platform where you're trading between different kind of cryptos. And because it is on the decentralized distributed network, that is called a decentralized exchange. And third, very interesting one is asset tokenization. So what's happening in asset tokenization is, imagine you have real estate. You have apartment, let's say somewhere in New York, right? Maybe in downtown, close to $10 million, right? A very small, tiny apartment. If I am sitting here in Delhi and I want to take part in the New York real estate market, for me, it's extremely difficult. I need to have that $10 million to be able to buy in that property, right? Otherwise, there's no. So either it is, in or out. I cannot have a fraction of that. But with blockchain, they are fractionalizing all of these assets. So that $10 million worth of apartment is broken down into, $500,000 worth of tokens. And those tokens are then sold. So I can then buy $10,000 worth of this, apartment in New York. I can have similar properties in London, Paris, Delhi. And so now I have a real estate portfolio. And when my value goes up and down, I can basically trade it on a secondary market. So that is happening quite a lot. And that is contributing to, as you can see here, 1.1. There are several other assets, it's not just real estate. And then the regular ones we've been talking about: payments, derivatives market, margin trading. So the top three, lending, decentralized exchanges, and assets, are primarily contributing close to 80–85% of the bulk of activity on decentralized finance ecosystem. And then there are a lot of other things. I've just listed 6 here. There are so many other things that are happening. Stable coins are there, which is like a coin tethered to the US dollar, so that then you don't have to actually transfer physical dollars. You're transferring digital dollars, which are tethered and therefore have the same stable value. So a lot of things are happening there. So in conclusion, what's happening in decentralized, through decentralized finance in the finance industry, is that the industry is getting to see the kind of disruption which I think it probably needs, because it definitely has the access problem which we were talking about, and it also has issues of not equal opportunity for people to take part in the ecosystem. So those two things are fundamentally getting addressed by blockchain. Now, there are obviously some of the bigger institutions which are taking keen interest in it. So the interesting thing here is I cannot think of at least any of the top major financial institutions globally who are not already experimenting with blockchain in some form or fashion. Either they are doing heavy duty proof of concepts, or they're actually implementing smaller projects because they have moved past that, whether it's trade finance, cross-border transfers. They're trying all sorts of things, right? So from that perspective, just picking two examples here. Two major corporations, JP Morgan, right? So JP Morgan has been talking about a coin, digital coin or crypto coin, JPM, right? So they are the ones who are looking to enter this crypto market very, very actively. And then Libra. Libra is a foundation run by Facebook. And it has people like, PayPal's, MasterCard, Visa. I know PayPal and a few others, sort of also exited that consortium or the foundation. But you can think of some of the major leading institutions, they're part of the Libra Foundation. Imagine when Libra comes to life, of course, there's a lot of regulatory hurdles before that becomes a reality. They are obviously have been to the Congress, testified, and happened, several other things have happened there. But Mark Zuckerberg is truly committed to this, coin. And imagine if that happens, which means half of humanity, in 2 years' time would have access to crypto. That would be huge in terms of taking the industry to the next level and actually bringing more equality and financial inclusion. The kind of financial inclusion we've been talking over the years actually is possible with this technology. The other thing which I see is this whole YouTube effect. So what is the YouTube effect? So YouTube came in and revolutionized, almost democratized the creation and distribution of content, right? Video content. So now anybody can go record their video and distribute it, right? Same is happening with the advent of blockchain. With blockchain, what's happened is now people can build in their own, specialist niche financial products. So I was talking about derivatives, insurance on derivatives, right? I mean, I have not heard of that, but I would be very surprised, if not be very surprised actually, if somebody comes up and is able to start that product, because it is possible. It is like those Lego building blocks. You build one on top of the other, right? And you have a new financial product. Then market for products which were never even envisioned, right? Never possible with the traditional finance. So I'll tell you, there's a very interesting phenomenon going on with multi-level marketing, matrix marketing, right? These sorts of marketing have been there for long, where you refer somebody, you get a certain amount of bonus, and then there's an upline, downline, all those mechanics, right? Now with the smart contracts, right, this whole thing is getting automated, and people automatically, as soon as you refer, there's a wallet address, you sort of get 20%, 30%, whatever is a referral bonus. So clearly that is something which a traditional financial institution can never be able to provide. There's a lot of risk, right? But then blockchain addresses some of those risks, right? The other thing is, again, very popular that I've heard of is a pool of people coming together every month, let's say contributing $10,000. So 10 people coming together, contributing $10,000, goes and gets logged into a smart contract, which means $100,000 locked for a month in a smart contract. And maybe there are ways to earn interest on that. There's yield farming and a few other concepts out there. And whatever is the interest earned on that through automatic e-voting, one of the persons actually gets that interest part along with their capital, and rest everybody gets their capital back, right? So nobody loses and somebody wins. And then this whole lottery and the voting continues, right? So these kind of models are there, right? And people are experimenting, trying out, and actually making money. And finally, value, which is obviously getting created in the whole process, and not just captured by some of the leading institutions, right? So it's not just the banks who are able to make money. Here, anybody who's taking part is making money. So the participant who is giving away the loan, or somebody who's earning interest, right? So everybody is, equally making money. It's all written in the smart contract, very transparent. As I said, it's all distributed, which means anybody can have a look at it. Nobody controls it. So that kind of a model is there, and it is really evolving. To sort of end this, obviously, this is what we do as a company. We are into the blockchain consulting space all the way till protocol development and exchange development. And obviously, I was talking about barter trade, our product in the exchange business. This is one of the leading products that we have been building for the last 1.5 years. And we recently completed a public crowd funding campaign, which was hugely successful. So, anybody's interested, let me know. I can share more information about our exchange. And this is my contact information. In case anybody wants to reach out to me or has any questions or queries or just want to chat, happy to do that. I don't know, how am I doing with time? I think that's okay. Can I take a couple of questions there?
Yeah, you can do take questions, of course.
All right, so I think I'll have to depend on Neeru is this where I look at it?
No, I recommend Anurag, what you could do is go to the Q&A. If there are any questions, I'm also going to go and look. And you can also look at the Q&A. I don't see any questions.
I see one question from BV Jagadish.
There's one question there by Jagdish.
You go ahead and read the question.
Right. Let me do that. So the question from Jagdish, thanks a lot. A very interesting question, Jagdish, actually. So what Jagdish is asking is, what are some of the infrastructure innovation that needs to happen for blockchain to succeed and also to work seamlessly in many use cases? So I'll answer that question, Jagdish, by saying this is one of the leading areas of R&D within the space, right? So I would say some of the sharpest minds in the blockchain space are spending most of their time thinking about the infrastructure, because there's this whole concept of fat protocols, thin protocols. I mean, maybe we can talk about that separately. But today, majority of the value in the blockchain ecosystem is getting captured by the protocol layer, right? And if I have to contrast that with the existing internet systems, nobody even thinks of HTTPS or some of the other protocols, underlying protocols, which actually enable communication, right? But in the blockchain space, majority of the funding, whether it's the VC funding or crowd funding, most of it is going to the infrastructure layer, because the infrastructure is very fragile, it is evolving, and it is immature. There are governance issues, there are standardization issues. But at the same time, some of the cutting edge work, especially in cryptography, in distributed networks, in consensus models, all that is happening in the space.
Okay, and there are some, Kiran K is asking a question. What is the next stage of pure?
Hello?
I think, yeah, and his thing, either it came in the Q&A or the chat. Let's look at.
So the Kiran case question is, what is the next stage of pure technical development happening in blockchain in terms of features, functionality, and security?
Right. Okay, so what's happening is there's a lot of convergence of technology. So what has been happening is, you have this Bitcoin network, you have this Ethereum network, so many other infrastructures which are getting built. One common challenge is, how does one blockchain communicate with the other? So obviously, that whole area is a major area of work where people are talking about how do you interoperate. So the work that is happening, and the way I see it, is that, you will have an infrastructure in, let's say, 5 years' time, which is very similar to the current internet setup, where you have these special public information portals, and then you have obviously government areas, enterprises, all of them transacting through a common internet layer, right? And the same thing is going to happen with blockchain. You will have a top overlay infrastructure, which is going to enable the seamless public-private, hybrid conversation seamlessly, which is not the case today. So that is where a lot of work is going on, and also a lot of value creation will eventually happen.
There's one more question from K. Raman. How does an individual or small business get started to use or set up a blockchain? What is the work to be done?
Well, it's very easy, actually. So if you have to, lay your hands into the blockchain ecosystem, you can actually create your wallet, become a part of one of the networks, and actually start, as I was saying, you could actually begin trading at the very least, right? So barter trade, the exchange that we have launched, or so many other exchanges, just become, do yourself KYC there, get your account and start trading, and you will then learn how does transaction get confirmed, what are some of the intricacies around there, and you start to build things from there. If your idea is to look at the blockchain infrastructure itself, again, you can have a copy of the Bitcoin or Ethereum, some of the leading blockchain networks, and fork it. Fork it means you have your own private version of it, and then you start to modify, build applications on top. It's slightly technical, but again, that is not very super technical in the sense that you have to write everything from scratch, right? Everything is open source out there. All you have to do is take a copy and start modifying and building it.
Okay, let me see any more questions in case. V. Jagadish is asking again, one more good question.
Right.
What markets do you think would be, you're seeing it?
Yeah, I can see it. Maybe I'll read it. So what markets do you think would be the first adaptation of blockchain on a large scale? Finance, healthcare? Honestly, finance obviously has been the prime use case. So as I said, all major financial institutions are trying it. But if anything after finance, obviously it's not healthcare. Healthcare has a very good, sort of fit with blockchain. But because it is so regulated, I think it's going to take a while before they have full adoption. But supply chain, as you saw in my presentation, where I was saying inception to date records, everything is, connected. So there's complete traceability end to end. And that is what supply chain is all about. So we are building some cutting edge supply chain applications, and supply chain, I think, is a prime use case after finance. And supply chain is easier because there's not a lot of regulation involved, right? So, finance, obviously, all these startups and other players are, making a foray. Whereas if you look at supply chain, some of the leading institutions are, leading shipping industries, logistics industries, they are taking a lead there because it's not regulated.
Also, just FYI for all, we did a 3-day global blockchain conference before, and we had talks from financial institutions like banks and other institutions as well as governments. And many banks have dabbled into or entered into the blockchain market, including the governments trying to see how they have to do. From the state of Washington, one of the advisors to the governor was a dean level before, highly technical, came and gave a talk. Just for information, you can go back and refer to it. I think now we have more questions coming in from, okay. Where do you get the material, BV Jagadish? We will try to put that up, and then contact us back, contact Lena or Sridhar and me. We'll be glad to provide the presentations to you. And he can also share his presentation, Anurag. And I think there is a question from Kiran K again. Could you give us some open source blockchain and take a look at it?
Right. Can you give some open source blockchain technology platforms that come with the ready infrastructure to build blockchain based applications? Quite a few, I have to say, but I would recommend Ethereum, to be very honest, because it is very mature. It has a huge community support, right? It is obviously the first truly open blockchain system after Bitcoin. So Bitcoin was primarily for financial transactions. So Bitcoin blockchain was only for Bitcoin transfers, whereas Ethereum network has the ability of smart contracts and other things. So suddenly it opens the whole world up for business application, custom building, right? So if you have to try anything, go with Ethereum, and then of course Consensus Studio, which is sort of closely working with Ethereum. The co-founder of Consensus, Joe Lubin, is also the co-founder of Ethereum. So there's that whole synergy where they are incubating Ethereum-based startups, right, through seed funding and other things, and then they are providing tools for developers who are working in the Ethereum ecosystem. So I would recommend using that. And
Anurag may have already clarified, don't get confused between the blockchain and the cryptocurrency. There are two separate angles, even though cryptocurrency movement uses blockchain infrastructure. Cryptocurrency is a totally different thing. And a lot of people are offering there used to be so many ICOs happen, and thinking that everyone can create currencies and go ICO before instead of IPO. And a lot of that has changed over time. And I have a question which is pertinent to the COVID situation. What are the effects of COVID in terms of the blockchain? I'm not worried about cryptocurrency right away, because blockchain has more supply chain related and variety of applications.
Right.
If you could enlighten.
Right. It's a very good question, KRS. And I'll, but you saw my graph from January 20, $650 million in decentralized finance to 9 billion, right? And it's just growing crazy on that piece. So this is obviously the decentralized finance piece. But if you look at supply chain, you rightly pointed out, a lot of digitization. So why some of this adoption happened in this? So as much as this has been a very unfortunate period for humanity with all the COVID situation, it's not been bad for the blockchain industry or the technology, because there has been a huge shift. People started to see the value of how this can actually help move value around with little friction, right? So therefore, the adoption both on the finance side and non-financial applications, especially supply chain. So imagine all the supply chain changes, especially with respect to China, that are happening, right? People are now looking to diversify their supply chains out of China to multiple locations, right? And so it's a prime time for supply chain industry using blockchain technology, obviously we are working with a couple of major players, including folks out of IBM for a supply chain platform through a client in Texas. But this is obviously a major area, I have to say, where a lot of things are happening.
Okay, that's good. And
there is a question in the chat
can you come to the other link?
From Kiran. She's asking,
Neeru, you can take care.
Are there any blockchain open source technology platform to start building apps?
Right. I think I probably answered this, but the best source to look at is Ethereum and Consensus. Consensus is CONSENSYS. Consensus. Consensus and Ethereum. If you look them up, I think you will have most of what you need actually.
Okay. And there is one more question in Q&A from K. Raman. What computing power would one need to set up a small blockchain? Hashing, verifying can need a lot.
Yes. So I think it is, again, when you say small, again, it is going to be entirely dependent on the use case you're looking at, right? What is the specific?
There. I'm just jumping onto it. Oh, right. Okay, sure.
Right. So, Raman, I think it is going to be entirely dependent on your specific use case, because the resources you're going to be utilizing, right, is going to be dependent on that. So if it is a very lightweight transactions which you're going to be approving, that's different. So imagine if you're going to be storing videos, right? So what sort of infrastructure you're looking at compared to very small, data packets. So I think that is where it's going to be dependent, and obviously what kind of consensus mechanism you're going to apply, how the different layers are going to be put together. So all consensus are not the same, right? I think we briefly touched upon how approvals happen in the Bitcoin network, right? Through the proof of work, where we talked about 6.25 Bitcoins are rewarded. Then there are lighter versions of the consensus. There's pluggable consensus, there's dynamic consensus, and then within that, there are various other variants. So dependent on how you pick up these, building blocks, this can be optimized as well. Otherwise, it can get very complicated and expensive, like Bitcoin is today. So Bitcoin is extremely difficult to scale because the way infrastructure is set up. But it's the most secure blockchain that you can have, right? Because of the proof of work that it implies. So it depends on whether you want to sort of optimize in terms of transaction approval. Do you want to have faster speed of approval? So Bitcoin network obviously takes 10 minutes to approve. Ethereum takes only 17 seconds, right? So a lot of things sort of go into consideration.
Okay, so now it's our time to conclude this workshop from Anurag. Thank you, Anurag. That was very informative.